Why does the Reserve Bank of India's policy rate decision matter? It's not just a number on a page, but a reflection of the current economic climate and a predictor of future trends. The recent decision by the RBI's Monetary Policy Committee to leave the policy rate unchanged didn't come as a surprise to many. The central bank's focus continues to be on maintaining inflation at the durable target of 4%, underpinned by the healthy pace of economic growth. One of the key highlights was the moderation of core inflation, which includes services inflation. Over the past few months, this has been on a downward trend, providing some relief. However, the central bank's main concern remains the persistently high food inflation and its potential to impact household inflationary expectations negatively. The expectations of a normal monsoon this year are a positive sign for food inflation. Yet, it's crucial to keep an eye on the continuation of geopolitical rifts and the potential supply-side risks that could impact commodity prices. Furthermore, increased climate risks in both the domestic and global economy have emerged as significant risks for food inflation in recent years. Looking ahead, the central bank may consider a real rate of interest of around 1 to 1.5%. As inflation moderates to around 4.5% and as the US Federal Reserve starts cutting rates, we could see RBI going for a shallow rate cut of around 50 basis points in 2 tranches, starting in the third quarter of the financial year 2025. Today's decision to maintain the status quo on the repo rate was anticipated. The central bank acknowledged India's resilient macroeconomic backdrop, which affords greater policy space for the RBI. However, the central bank doesn't seem to be in a rush to start cutting the repo rate. While the RBI kept the financial year 2025 Consumer Price Index forecast unchanged at 4.5%, the CPI for the first 2 quarters was further lowered, potentially to a sub-4% zone. This could push the real repo rate beyond 2% for a while, strengthening the case for repo rate cuts later this year. However, the timing of RBI rate easing will involve several other factors. Most of the major global central banks appear to be cautious to start easing policy rates. There's a lot of uncertainty around the US Federal Reserve's expected rate easing in June, and against this backdrop, it seems unlikely that the RBI will cut rates before August. While the Monetary Policy Committee decided to keep the stance of the policy unchanged, there is merit in considering a change to a neutral stance sooner than later. The case for a change in policy stance to neutral in the coming Monetary Policy Committee meetings is stronger now. For the financial year 2025, the gross domestic product growth prediction remains unchanged at 7%. However, quarter-wise predictions have been adjusted. In the first quarter, the GDP growth target is set at 7.1%, and for the second quarter, it's been fixed at 6.9%. The GDP growth for the third and fourth quarters has been predicted at 7% each. In conclusion, the RBI's policy rate decision is a careful balancing act, influenced by various factors like inflation, geopolitical rifts, and international rate trends. While the current stance is unchanged, there's a growing case for a shift to a neutral stance in the future. The central bank's focus remains on containing inflation and ensuring economic stability.